AstraZeneca fell as much as 13% in early trading on Thursday after its gene-silencing drug Wainua failed a landmark late-stage heart disease trial, erasing more than £20 billion from the company's market value, its steepest single-day drop since July 2017. The result came as a shock to Wall Street and to AstraZeneca's own management, who had expressed high confidence in the trial's prospects going in. What makes the result unusual is that Wainua did exactly what a gene-silencing drug is supposed to do. The trial confirmed large and sustained reductions in transthyretin protein, the biological target, consistent with the drug's mechanism. Yet that molecular success translated into no statistically significant reduction in cardiovascular mortality or recurrent heart events over 140 weeks. The drug worked. The trial failed. That gap is the central question investors are now pricing. The distinction matters enormously for the £20 billion that left AstraZeneca's valuation on Thursday. If Wainua failed because it cannot alter the course of ATTR-CM disease, the write-down reflects genuine biological reality. But if the trial's design was overtaken by a rapidly shifting treatment landscape, the drug's underlying potential may still be partially intact, and the scale of today's sell-off may be overstated.
The critical design detail is this. When CARDIO-TTRansform was designed, ATTR-CM patients were less uniformly treated. By the time it read out, 57% of participants in each arm were already receiving a stabilizer drug, Pfizer's Vyndamax or a similar agent at baseline, and another 24% started one during the trial. Adding Wainua on top of an already effective stabilizer gave the drug almost no headroom to demonstrate incremental survival benefit versus placebo. The contrast within the data is telling. In patients already receiving a stabilizer, Wainua showed no treatment effect at all. But in the pre-specified subgroup receiving Wainua without a co-stabilizer, the composite endpoint showed a nominally significant hazard ratio of 0.71, a 29% reduction in risk. That single number is the most important data point not yet in the market's model, and it will be dissected in full at the European Society of Cardiology Congress in Munich in August. The consensus read is that AZ lost a drug. The buried assumption that consensus requires is that the standard of care in 2026 is similar to what it was when the trial was designed. It is not. Vyndamax alone generated $6.4 billion in sales last year, meaning the majority of enrolled ATTR-CM patients in a contemporary trial arrive already partially treated. Eplonterson's trial was essentially testing whether a second agent beats a control arm that was also receiving more active therapy than originally planned. That is not a proof of failure in a drug-naive population. Two named analyst teams reached opposite conclusions from the same data. Jefferies analyst Michael Luchand argued the failure does not impact AstraZeneca's $80 billion 2030 revenue target, since Wainua was not one of the primary pillars of that projection. JP Morgan's Richard Vosser, by contrast, anticipated market consensus would remove the majority of the $3.3 billion risk-adjusted peak sales forecast attributed to Wainua. Both cannot be right. The split rests on exactly how much of the $80 billion plan was implicitly backstopped by Wainua's cardiomyopathy expansion, a figure AstraZeneca has not disclosed.
Capital did not evaporate. It rotated. On the same session that AstraZeneca fell 9%, Alnylam Pharmaceuticals rose approximately 18%, and BridgeBio Pharma gained around 11%. The market was not simply punishing a failed trial, it was repricing the competitive landscape of the entire ATTR-CM franchise. With Wainua's cardiomyopathy ambitions now in doubt, the patients and prescribers who might have been targeted by AZ's commercial aims are now fully available to the two firms already selling approved ATTR-CM treatments. Alnylam's Amvuttra, a drug that uses a similar gene-silencing mechanism to Wainua but succeeded in its own ATTR-CM trial, reported sales of $2.31 billion last year, up 138% year-on-year, already confirming the commercial scale of this market. Pfizer's Vyndamax, the stabilizer that saturated AZ's trial, generated $6.4 billion in sales last year and remains the market anchor. AstraZeneca was targeting entry into a market already generating close to $9 billion in combined annual revenues that will now accrue to rivals without AZ in the competitive set. The one strand of AstraZeneca's Wainua franchise that is not in question is its existing approval for the polyneuropathy form of ATTR, a separate indication where the drug is already approved in more than 20 countries and generated $220 million in sales last year. That revenue is unaffected. What Thursday's result eliminated is the prospect of a 6 to 10x commercial expansion into the far larger ATTR-CM market, where patient volumes run 300,000 to 500,000 globally versus fewer than 50,000 in the nerve form. The asset did not disappear, its addressable market shrank by roughly 90%.
The central dispute between Jefferies and JPMorgan resolves to a single undisclosed number. How much of AstraZeneca's $80 billion 2030 revenue target was implicitly supported by Wainua's ATTR-CM expansion? AZ management had expressed confidence in the trial, precisely because the cardiomyopathy market was seen as a material contributor to closing the gap between today's $58.7 billion revenue base and that 2030 ambition. Jefferies argues the company has enough oncology and respiratory pipeline to cover the loss. JPMorgan's read implies the cover is thinner than management presented. Against this uncertainty sits a valuation argument that holders cannot simply dismiss. On a discounted cash flow basis, using AZ's latest 12-month free cash flow of approximately $9 billion, one model estimates intrinsic value at around £228 per share, roughly 45% above the post-fall implied market price. The earnings multiple tells a similar story. AZ trades at 24.7x, below a model implied fair multiple of 39x, given the company's size, margins, and historical growth profile. The market is pricing in a material pipeline re-rating, but whether that repricing is proportionate to a single trial failure is exactly what creates the decision pressure Thursday's result leaves unresolved. The management credibility dent is real, Jefferies named it explicitly, and the next checkpoint that resolves it is August's ESC Congress, where the full CARDIO-TTRansform dataset will be presented. If the monotherapy subgroup's hazard ratio of 0.71 holds under full statistical scrutiny, AZ retains a regulatory path for Wainua in stabilizer-naive patients, and the market's re-rating will look excessive. If the full data confirms no subgroup signal worth pursuing, the $4 billion revised peak sales forecast is the ceiling, analyst consensus converges toward the JPMorgan read, and the 2030 target faces a credibility gap it cannot paper over with pipeline optionality alone. For holders, the near-term signal to watch is not Thursday's price move, but the analyst consensus revisions to the $80 billion 2030 target that will emerge over the next 2 to 3 weeks as sell-side teams update their models. A cluster of downgrades to that target is the signal that credibility loss is structural, not episodic. For watchers, the ESC Congress in August is the discriminating event. The monotherapy subgroup data either rehabilitates Wainua in a narrower ATTR-CM population or closes that path entirely, and that outcome is the condition that determines whether Thursday's 45% discount to DCF intrinsic value is an entry setup or a value trap.